Hello guys, Joseph here. Okay guys, in today's video I'm going to be talking about liquidity, imbalance or inefficiency. Okay, you must have heard of the word liquidity or imbalance or inefficiency, and you might be wondering what it is, or maybe you don't really understand how well the concept very well. But in this video I'm going to try and explain liquidity, imbalance and inefficiency in a very simple way. Okay, so imbalance and inefficiency is the same thing. Okay, but sometimes people tend to use the word inefficiency or imbalance. So but any of these two words you hear, or they mean the same thing. Okay, so now what is liquidity? Okay, liquidity simply means the market trying to grab liquidity, trying to hunt for stop. Sometimes retail traders call it stop loss hunt. Okay, they call it stop loss hunt. Okay, so this can be seen as a perfect low. Okay, so price is forming a perfect range. Okay, let me draw it as well. Okay, so now what is liquidity? Liquidity is when it simply means when you are seeing this now, you are saying that this is support zone, and this is a resistance zone. Okay, that this is forming the perfect support and resistance zone. Okay, and when price gets to this place, the price comes and does like this, then breaks. Okay, breaks and start coming down like this. Okay, so this is just liquidity inducement concept. Okay, so liquidity simply means price forming equal highs and lows. Okay, then later comes to that point and grabs liquidity. Okay, so that's just what liquidity means. Okay, okay, so let me show you just a few more examples. Okay, all right, so let's say here. Okay, let's say this it could be a buy trend. Okay, and price continues doing like this. Okay, then here now this is a perfect low. This is a low. Retail traders see this low and they'll say this is a resistance zone, and this is a very valid zone. Okay, so price comes back to this zone. Okay, taps this zone. Okay, and retail traders like, oh my god, price is in support and resistance, they'll place a buy trade. Okay, as price start going upward, they'll be like, this is like the buy is confirmed, like this buy that they see that is happening now is like more confidence. Okay, so price can still come and do like this. Okay, and continue, sorry, okay, now price can come and do like this. Okay, and continue going upward. Then retail traders, even some people when they see price at this level, they'll be like, price just came and touched this support and resistance zone, and they start buying from this place, and before you know, price comes down and take out all the liquidity, all the stop loss, because anybody that is buying from this zone have their stop loss hidden under these candles. Okay, some of them their stop loss will be down just at this bottom. This is where every reasonable trader will put their stop loss. So price comes and grab the liquidity. Okay, and still comes and continue doing the uptrend. Okay, so this is just the concept of liquidity grab. Okay, price engineers equal highs and equal lows. Okay, equal highs and equal lows, then price later comes and take the liquidity and continue going upwards. Okay, or price can engineer a equal highs and lows like this. Okay, comes, breaks it, might not even break it instantly, comes, then give every buyer this small buy trade that's currently happened. We give everybody in this trade some hope and make them feel happy because they're already in profit. Then price comes and break the zone, triggering all their stop losses, grabbing liquidity and continue going back downward, or price can still do anything it so wants to do. So that's just the concept of liquidity grab. Okay, so whenever you hear liquidity, simply means price grabbing, the price looking for money, okay. So like I said before, that sometimes that in a structure that you might think that there has been a break in structure, but price is just grabbing what's it called, liquidity. Okay, so maybe this is a buy trade, okay, and price is respecting these levels, then price suddenly comes, breaks this structure. It might even come down here, break this one also, then see price continue going back upwards like this. Okay, so now here in this case price broke this structure here, also broke this structure here also, but price still continued going upwards. Okay, why is this not a change? Why is this not a breaking structure? This was just a grab of liquidity. Because the institutional traders already know that everybody that is buying this trade from maybe from here or from here, they will have their stop losses hidden under this zone, hidden under here, under this swing low here, or under this even people that bought from here, that's already buying from here, they will hide their stop loss from here. So price will just come and hunt their stop loss, grabbing all the liquidity and going back upwards. So that's just how this is just the concept of liquidity grab. Okay, so hope you understand. Now let me show you for sell trade. Okay, for a sell setup, let me show you. Okay, now so price could be selling this way. Okay, so now here now there's an engineered high, equal highs and lows. Okay, so sometimes price just come and tap it the third time. When price taps this thing the third time, everybody that is seeing this will be like, there's a triple top here, or there's head and shoulder. This thing retail traders normally call head and shoulder, and you find out that price still comes, grab liquidity and continues going down. Okay, have you ever seen something like this happen to you when you're trading? So this is just this concept of liquidity grab. Okay, so you have to know about this, like, and we use this concept. Okay, we use it to we also use this while trading the order block. Okay, the order block strategy. So you just have to understand all these things. Okay, all right. So one more example. Okay, and sometimes price can be selling like this, comes, grab liquidity, continues selling. Okay, so this is just a grab of liquidity. Okay, grabbing the liquidity in this zone. So this is just what liquidity means. All right, so now what is imbalance and inefficiency? Don't worry, I'll still come to the chart and show you examples of liquidity grab. Now what is imbalance or inefficiency? What is imbalance or inefficiency? Imbalance simply means when there is when price is inefficient. Okay, when price is inefficient, because now you know, for price to move there must be 50% buying and 50% selling. Okay, for price to be efficient, for price to move, there must be 50% buying and 50% selling. This is like the rule of the market: 50% buying and 50% selling. But sometimes, because of institutional traders, when they enter the market with huge lot size, just imagine someone having an account of $50 million enters a trade with full lot size. You see that there will be a very strong move in price, thereby creating, okay, this is how price move now. There will be a strong move in price, thereby creating inefficiency. Now can you see here, there was inefficiency here. Price was inefficient here because there was just pure selling pressure here. Here also there was pure selling pressure. From here to here. The only place there's a wick is inside here. So price just bought inside here a little bit and sold inside this candle a little bit. But from this zone, from here to here, it was just pure selling pressure. Here also here, there was just pure selling pressure. So the price here is inefficient. So this price can be called inefficient or imbalance. So after price doing everything he wants to do, it will still come back and start feeling all the inefficiency, start feeling them later on. So it's not as if whenever you see any inefficiency you just jump into the trade. Price can still maintain its structure, keep going down, and later come back to feel the inefficiency. But if you are not having a very large capital and you decide that you want to now come and start buying to feel this inefficiency, price might go downward, blow your account, clean it finish before starts going back upward. So you don't just trade inefficiencies blindly, okay? But we add them, we integrate them to our other block strategy. All these things serve as confluence. We use them to read the market makers behavior. We use them to detect if institutional traders, if they've entered the market. Because you know that we retail traders we cannot move the market. We cannot move the market with our 0 points, with your 1 lot size or your 0.0 lot size. You cannot move the market. Your positions don't really have effect on the market. But the market makers, those guys that trade with large sums, institutional traders, they are the ones that move the market. This concept I'm teaching you happens in all markets. Any market that has candle, okay? Someone, an institution or the banks, they need to move price, okay? You don't have that capacity to move price, okay? You don't have that capacity to move price. So we always come and detect when institutions, when they are in the market, and we trade in line with their direction, because they are the one that can move price. If you buy a market here and there's no liquidity, there's no volume, there is no money to move the price upwards, you will not be in profit. So you have to always buy when institutional traders are buying, okay? So that's just the concept of this strategy. We buy when we try and figure out when they are buying, and we buy alongside institutional traders. So now look at what I just draw here. Can you see that from here price came, see here, this was the last low, and this pullback came and closed this price, making this efficient. So price also was efficient here. Also here price was efficient because the gap was closed. Here also price was efficient because it was closed here, okay? So hope you understand these things. They are very simple, okay, but I just try and make them very easy. I am explaining them in a layman's way, so you can just understand them very well. All right, so we'll be moving to chart examples. We're going to chart examples. So let me show you what inefficiency means. Let me show you from chart examples. Okay, so this inefficiency, they can happen in all time frames, from 15-minute time frame to 30 minutes, 1 hour, to the daily, to the weekly. Price inefficiency can happen everywhere, okay? So now let me use this example here, okay? Let me use this example here, okay? So can you see from here to here? Look at what happened here. From here, look at the wick. Look at the wick here. There's a wick here, and here also. This is where price stopped. So there was a price imbalance or inefficiency here. Can you see that there was an inefficiency here? And this is the 1 hour time frame. So price was inefficient here. And can you see that price kept selling? This is step index. If you had held this trade if you had bought from here in the hope that price will come and close this inefficiency, can you see that your account would have blown? It would have blown your account, or you've been a very big drawdown. So this is price inefficiency. This is just a very good example of price inefficiency. Okay, so let me look for more examples, more chart examples. Okay, so we are not just trading these inefficiencies, but we are using them to detect institutional moves. Okay, from here to here, can you see? From here to here as well. From here to here, price was inefficient. Okay, it was inefficient, and this inefficiency has not been closed. Okay, but if you trace it now to current price, you find out that it has already been closed. All right, so okay, I still have to show you examples of imbalance. rather imbalance and inefficiency, they mean the same thing. Okay, but I still have to show you examples of what's it called, liquidity. Okay, I still have to show you examples of liquidity. Okay, but let me just show you a few more examples of price imbalance. There was an imbalance here, price came to fill it. There was an imbalance here, price came to fill it. Okay, so there are imbalance in the market, and price always come to fill those imbalance, making price efficient. But it's not every imbalance that you focus on, it's not every imbalance that you trade, it's not every imbalance that you trade. Okay, so now what is, let me show you examples, chart examples of liquidity graph. Okay, concept of liquidity graph. Okay, so trying to look for a very good example. Okay, yes, now if you are trading trend lines, this could look like a very good trend. From here to here, it could look like a very good trend. Don't mind this first trend line, just focus on this one. Okay, I know it's not perfect, it's not straight, but I'm just showing you, trying to give you. Okay, let me use okay, yes, let me use this is the trend line too. Okay, now can you see, from, if you are trading this pair now and you carry your trend line and you measure this, can you see how perfect, how price perfectly lined up? So this was an engineered trend line. Now price came and tapped it the first time. Tapping it the first time, you might not really identify or know that it's a trend line, but the third time that price tapped this trend line, can you see that it showed, it was visible, now price came and tapped this trend line and started buying. If you had seen it here, you'd be like, oh my god, there's a trend line here, you buy. But now price got to this point, instead of continue going upwards, hitting our first take profit here, our second take profit here, price came back and broke the trend line and came back for a retest. Price came, broke it, came back for a test, continue going downwards. Can you see how simple this thing is? But we don't trade all these things anywhere, we don't trade them randomly. Okay, we don't trade them randomly, but I'm going to show you how to integrate all these things in the order block strategy. So the next video I'll be making is the order block video. I'll to be a very detailed video. Okay, same thing here. Okay, but now in this case it was respected, trend line was respected. Okay, I'm looking for a perfect lows. Okay, liquidity graph. Okay, now can you see what happened here? This price was respected. Can you see it tapped here once, second time, third time, fourth time. Okay, fourth time, and it respected it because general flow is bearish. Okay, I want to just get more examples of liquidity graph, I want you to understand it very well. Okay, okay, this could be classified as a liquidity graph. Okay, all right, here, can you see that this was a low, this is a low, price was making this low, and here in this point, this candle here, this small candle here, this first candle was if you had come and met price exactly in this candle, when you place your rectangle and you figure out your, what's it called, your lows, and you place your buy trade here, that you see that when price taps that level, then comes down into that level, breaking this low, grabbing the liquidity. Any stop, if you place your stop loss just below, anybody that is buying from this level now will place your stop loss just below this level, and this price has come, tapped, triggered the stop loss, exit you from the trade before going back upwards. Okay, so that's just how I just want to make this video short. Okay, but I still want to figure out more examples. I still want to get more examples. Okay, now this is a very good example of liquidity grab. This is a very good example. Okay, now, sorry, excuse me. This was an engineered low here. It was an engineered high. Can you see? Okay, let me try and make this a bit straight. Can you see? This was an engineered high here. Okay, so now price came, tapped here, came down, tapped here, came down. But we know that this is that we're in a sell trade, we're in a sell trend, we're in a bearish trend. Price came, tapped this level the first time, tapped it the second time. As retail traders, you'll be like, whenever price taps this level, that it makes it strong. There is a strong support and resistance level. Whenever price taps it a lot, it means it's a strong level. But can you see this liquidity wick, this liquidity candle? Price came and grabbed the liquidity here. Grab the liquidity. Can you see that? This is a 30-minute time frame. This is a 30-minute candle. So price came, sold, bought into this zone, cleared all the liquidity. If any breakout trader comes and see that the price has broken off from this range, and there has been a change in trend because price has broken this level, you saw this candle now, you saw that price is buying, you now come and start placing your buy trades. So many people will be jumping into buy trade because now they know that price has broken this their resistance level and price is going upwards. Now price came back down, started selling into all the buys, grabbing all the liquidity. Then this was a retest. There's another, you now left another block here. So this is the retest of the other block, and price sold downwards. So but we'll get to the other block strategy. We'll get to the part of the other block on strategy and also explain that. Okay, here also there was a grab of liquidity here also. Here, can you see these highs? Then this was a grab of liquidity. So price came back again and sold downwards. Okay, now if you are selling from here and you see that price is maintaining lower low, lower high, lower low, lower high, lower low, a lower high. Okay, and we are expecting more lower lows, but price came and grabbed liquidity from this zone. Anybody that started selling from here because you're expecting price to come down, go up, but you want to buy from a good zone to sell downwards. Sorry, you want to sell from a good zone downwards. Then if you start selling from here, price comes, grab all the liquidity, close all the trades here, grab all the stop loss, and started coming downwards. So that's just how this works. So guys, I'll see you in the next video.